All right, welcome back to the chapter 9 and 10 review, where we're going to review and wrap up the concepts that we've already learned. Just a little couple exercises to reinforce our learning. So here we are. Let's go to question number 1 here. Question number 1 says, if on January 1st you opened your store and needed a petty cash fund for emergency expenses, all right, and you establish the $500 should be enough for the first month of operations, okay? So let's go ahead and journalize this transaction. So remember, rule of thumb here, right? You only journalize to the petty cash fund when you need to establish, increase, decrease, or close. So in this case, I am establishing my petty cash fund. I need to move some kind of money over into the petty cash drawer, right? So in this case, it is January 1st, okay? And we're going to establish our petty cash fund, right? We need to debit our petty cash. Right, because we're increasing a cash flow. And we need to credit our checking, right? Because where does the money come from? It's not going to be loose change that you decide to just dump into a petty cash fund. You need exactly $500. And where are you going to get the $500 from? You're going to go either one or the other, right? Write a check and have someone cash it out and put the money into the petty cash drawer. Or you could go to the bank, withdraw that money, and put it into the cash drawer, okay? And it's going to be for $500. So in this case, we're going to put in here in our notes to establish petty cash fund, okay? All right, so then number 2, at the end of the month, you counted all of the receipts in the petty cash drawer, okay? And you had a total of $40.30 in cash remaining, okay? Replenish the petty cash drawer. So these are all the listed out expenses, right? When we started out the month of January, we had $500. Then our employees, right? We had Drew be the first one to take the money out to buy office supplies. He took out $20, came back with a receipt of $19.85 with the exact change of 15 cents. So therefore, the register has now $480.15 left. So in this case, this is the petty cash person, who's the manager, is keeping a record of who's taking the money, what was the reason why they took the money, what amount did they took, and how much did they came back with the exact change, right? We need to record the receipt here in our little register here, okay? So whoever the petty cash drawer manager is, they're keeping the track record of it, of the date and when and who and so on and so forth, and also getting an updated balance, right? So in this case, we already know that we have a total of $40.03 in the petty cash drawer. So how do we actually replenish the petty cash? Right now, it's just like having a little bank card, right? Or a prepaid card, right? Your limit is $500. And so far you've been spending. So how do you replenish that money? You need to pay back for all those expenses that you charged, right? So in this case, right? Now in this case, how do we actually spend the petty cash money? We don't spend the petty cash money directly, meaning every transaction that we have taken the money out for, we do not take it out directly from the petty cash drawer, okay? Because right now, when you establish an amount in your petty cash drawer, that amount should stay intact until you increase, decrease, or close it out. So in this case, right, I need to put exactly the $500 back into the petty cash drawer, right? So in this case, I need to tally up the total of my receipts and then write a check to that total amount. So then my petty cash drawer has $500 in cash readily available for February, right? So in this case, that's exactly what we're going to do. We're going to tally up our receipts. So this is right now, it's January 31st, okay? So let's see what was the first couple expenses that we had. First, we had office supplies expense, okay, for $19.85. So that will be my first expense that I have encountered, which is the office supplies expense, okay, for $19.85. Okay. Next we have here is business expense for $54.17. So we got some business expenses for $54.17. Okay. Then we had someone go ahead and buy some meals, right? For a total of $35.22. Okay? Okay. Then we had Miss Susan take another $20 to buy some meals. Okay, so in this case, we already had meals expense. So what I'm going to do here is I'm going to add the 35.22 to the 15, or add that 15 to the 35. Okay, so 35 plus 15, right? Because it's the same account. So total is $50.89. Okay. Next we have is a delivery expense for $50. So some delivery expenses. So maybe there was a COD for $50. Then there was another business expense. Another business expense for $22.78. So I already have business expenses here. So I'm going to go ahead and add that to the previous one. So I'm going to take 54 plus $22. Right, that should give you a total of $76.95. Okay. So after that business expense, we have more office supplies here for another $6.99. So office supplies. Okay. And then after that office supplies, we had another delivery expense for $100. So you could just add $100, so $150. Okay. Then we had advertising expense for $50. Then we end up spending another delivery charge for $25. So that is $175. Okay, then we had another business expense. Business expense, $76.95 plus $30.33. Okay. And last but not least, we had an owner's withdrawal. So you could just do withdrawal, which is going to be a debit for $50. Okay. Then the rule of thumb here is all of this should tally up your total to the amount that you're going to be writing a check to, right? Because you need the exact change. You can't just go to the ATM and pull this money out, right? You have to go into the bank and actually get the exact change here, right? For a total of $454.07. Now, if you did your math correctly, right, that amount that you're going to write to plus the $40.03 should give you a total of $500. And does it? Let's do the calculation. If I add 3 cents, I'll make it to $460. $460 plus $40 gives me exactly $500. So in this case, this is what you need to do. Okay? Now, another quick and easy way to do this is you could have also summed up your total expenses right here. Okay, so then you can actually get an idea how much you're going to be writing a check for. So this would also give you that $459.97. So then you could just split up your expenses accordingly, right? So remember, this type of accounting, right? We don't recognize the expenses until we replenish the petty cash drawer, right? So in this case, I'm going to go ahead and write to replenish petty cash fund. Okay. All right, question number 3 says on June 1st, your business is beginning to pick up, and the last few months, you were running low on the cash in your petty cash drawer. Okay, so then you decided to increase the amount by $300. Okay, record this transaction. So remember, we're moving up our balance. Right now, it's currently at $500. I need to increase it by $300, right? To get a grand total of $800 in my petty cash drawer. So that's how we have to deal with or look at it, right? We're not putting in $300 in there, right? We want to get a grand total in the petty cash drawer to be $800. So we're increasing it. So in this case, it is June 1st. We're going to raise our petty cash drawer amount by cutting a check for $300, right? So now you have a grand total of $800. Right? So in this case, to increase petty cash limit. Number 4, at the end of the year, you decided to get rid of your petty cash drawer, okay, and start using a business credit card for all minor expenses. Record the close of the petty cash drawer. So, right, if you remember, if it is at the end of the year, so December 31st, right? And we decide to close out the petty cash drawer, right? Like as if it doesn't exist. Where are you going to put that $800? You're not going to pocket that $800. You're going to put that money back into your checking account. Okay, right? You're going to take all that money and deposit to your checking account. And then you're going to credit your petty cash drawer because you no longer have one. It ceased to exist now. And it's for the total amount of $800. So we're assuming this is all related, right? Because originally you established it in January at $500, then you increased it in June by $300, giving a total of $800. So now that you're closing it and you're going to replace it with a business credit card, then there you go. That's exactly what you need to do. All right, to close out petty cash fund. Okay. Now, of course, you're going to record the business credit card and, the interest that you collect on it and all that, so on and so forth. But the difference between that, once again, a business credit card is you're charging right away and you're recording the expenses right away because it acts as if you paid with cash, right? You just end up racking up a liability instead. Okay? So that was chapter 9, okay? Petty cash. So let's continue on, right? On question 5 here. If on June 15, customer A decides to purchase a total of 100 toys for $5 each on an account. Sales tax is 8.25%. Record this transaction. So, right here down below, here's your journal space. So, on June 1st, customer A decides to purchase a total of 100 toys at $5 each. Okay? Plus, we have to record the sales tax. Okay? Now, in this case, it doesn't tell me how did customer A recorded this, but chapter 10 is about receivables, so we're gonna go ahead and put this on an account. So, June 1st, customer A says they bought 100 toys at $5 each on an account, right? And here it's going to be you sold something and you charge the tax for it. Okay? So in this case, right, you sold 100 at $5 each. We'll give you $500, right? Tax is going to be 8.25%, which will be, I gotta do that again. Okay, will be $41.25. So therefore, customer A owes us $541.25. And of course, you can make a note here too, right? Saying that customer A purchased 100 toys. Okay. Right now, we're not going to be dealing with inventory, so we're just going to record the sales, right? Because the important lesson here in chapter 10 is, what do I do when a customer pays me and they owe me on an account, right? So right here, I'm just going to go ahead and say customer or sold 100 toys to customer A. Okay? Now, of course, customer A, right, decides to promise you that they'll pay you back, right? So here, this question number 6, July 15, okay? We received a payment check of $50 from customer A. Record this transaction. So again, customer A decides to promise us to pay us back slowly. Maybe she'll make monthly payments of $50 to reduce the balance that is owed to her or owed to us. Okay, so in this case, we're gonna go ahead and record that on July 15. We received a check for $50. Okay, from customer A. Record this transaction. So, because we received money, right? So it's July 16. Okay, so it is July 15. And we received a payment, right? When you receive a payment, what's going to happen? It's going to increase your checking account because we've received a check from customer A, okay? and it's going to reduce the accounts receivable, right? So in this case, right, we received a payment check for $50 from customer A. And it's going to reduce your accounts receivable for $50. Now remember, we received $50, so that means if you want to have a little quick T account on the side here to know how much money customer A still owes you, it's up to you. But I'm going to go ahead and record that we received payment from customer A. Okay. Number 7 says, on August 15, customer A refuses to pay for the remaining amount she owes. So in this case, how do we record this transaction? So here, we're being flagged that it's a potential bad debt here, right? Potential bad debt. And it's during the year, and we know exactly who. So in this case, right, using the allowance method, right, how do we record that we have potential bad debt? During the course of the accounting period, and we know exactly who. You're going to use the allowance for doubtful accounts and transfer the amount from the accounts receivable into the allowance for doubtful accounts, right? You always do that during the year. This is how we have a debit or credit balance in the allowance for doubtful accounts prior to writing off our bad debt. So in this case, it's August 15. And we are looking at customer A's accounts receivable amount for the amount that she owes. So in this case, let's go ahead. So we know for a fact that we're going to transfer our amount to the allowance for doubtful accounts, right? And what this is it's like a placeholder account, right? So then we can separate our real money that we will be receiving from our customers, right? The ones that are still paying them. And then what we're going to do is we're going to place them on a hold, right? Or freeze their accounts. Like usually what they do is if you don't make a payment, what happens is they stopped your activity from you from charging more on your card, and they freeze your account, right? So that's exactly what we're doing right now. Even though the account still exists, yes, there's an account balance that still exists, yes, we're freezing her account because she refuses to pay. So therefore, she can no longer buy anything, and she can't do anything except for either pay the rest of the remaining bill off, and so on and so forth. Okay? So in this case, right, that's exactly what I do. We're going to remove the amount that she still owes us. So in this case, how much does she still owe? We know for a fact that, right, originally she owed $541, and she made a payment for $50 here, right? So therefore, she owes currently $491.25. Okay? And what I'm going to do here is I'm going to go ahead and make a note to remove customer A's accounts receivable balance. Okay? We're going to temporarily freeze her account. And she owes currently $491.25. So yes, this includes tax. Now, in this kind of situation, how would you distribute this tax? Well, right now, if you're going to write this off, right, which includes the tax, you're also writing the tax off as well, right? Because in this case, the sales includes tax. Now, it's up to your discretion whether you want to record or report this tax, right? But if you don't collect the money, that means the tax money was never paid to you. So if you want to reverse it, that's up to you. In this case, when you have bad debt like this and you write it off, then best rule of thumb is, whatever amount that they paid, right, goes towards your actual sales. It doesn't go towards the sales tax, right? Because how can you charge or pay your sales tax if the person didn't even pay for the items at all? So in this case, that is up to your discretion and what you want to do with that sales tax money, right? But in this case, it's as if this person you never sold anything to this person, right? So there isn't any sales tax to collect. But in this case, that's just a very minor thing. And if that's the case, then you're going to have to adjust your sales tax accordingly to go ahead and report this correctly. Okay? But in this case, that's not our main focus. Our main focus is, what do we do when this person chooses not to pay? Okay, so there you go. We record it as an allowance. We put it in a placeholder account to temporarily freeze their account. Okay. So question number 8 says, we contacted the customer A to retrieve the debt that she owes. Okay, and then finally on October 20th, we receive another pay of $15 from customer A. Record this transaction. Okay. So how would we record that we finally received a payment on October 20th? Okay. How do we go ahead and record this? So in this case, October 20th, okay, we received a payment. Okay. Now, first things first is, well, right now, does customer A still have an account balance with us? Yes. But right now, where is it? Is it active or is it inactive? Right now, it's in the allowance for doubtful accounts. Now, can you receive money and take it out from allowance for doubtful accounts? In this case, it seems as easy as you can, but according to the rule of thumb here, that is not the proper way to do it. Okay? So in this case, no, you cannot take the money out directly from the allowance for doubtful accounts, because right now that is a temporary placeholder account, right? This is because we froze her account. So how do you make an account active again? You need to unfreeze her account, putting back the entire amount balance in there. Why is that? Because if she shows potential that she's making a payment, that means she can continue to make those future payments. So in this case, we need to activate her account again, because now she's making payments. So in this case, there we go. We need to reverse this transaction by putting in the accounts receivable. Okay. And this is where we're going to have the allowance for doubtful accounts, right? Now in this case, this is why you would have a credit balance in your allowance for doubtful accounts, because remember, at the end of the year, we have to have a credit balance, right? So because when you start at the beginning of a year, if your customer that you assumed wasn't going to make a payment for, so again, the bad debt's an estimated amount, right? And they end up making a payment, what happens to your account balance? It becomes a credit balance, because guess what? This person paid when we assumed that with the estimated that it involved everybody. So in this case, we end up receiving the payment anyway. Right? Or maybe this person decides to come back the next year and decides to make a payment to you. We don't know. So in this case, that's exactly what you're going to do. You're going to reverse this transaction. And then you're going to, for the $491.25, Okay? And I'm going to go ahead and identify here my journal is to move customer A's accounts receivable balance. Okay. And then now that she's active again, you can then record your payment, right? Record that you received another check and that it's going to end up reducing the accounts receivable. Okay? So therefore, we end up receiving another check for a total of $15 on October 20th. And of course, we can make a note here saying that received payment from customer A. Okay. Then here, question 9 says on November 28, a debt collector has informed that customer A has filed for bankruptcy and can no longer pay. Record this transaction. So now it's confirmed that customer A can no longer pay for their account balance. So what do you need to do here, right? You need to once again freeze that person's account so then you can properly do the necessary things for your adjustment entry at the end of the year. So in this case, November 28, we already know we're going to put the account balance back in the allowance for doubtful accounts. All right, which is going to remove from the accounts receivable. Okay, to remove customer A's accounts receivable balance, right? And it's going to be now, right? It was $491.25, but we end up making another payment of $15. So right now, she owed me $476.25. Okay. And then last but not least, okay, says right here, number 10, on December 31st, our company estimates that $2,556 out of our 200,000 accounts receivables is to be uncollectible. And the current debit balance of $476.25 is in the allowance for doubtful accounts. Record this adjustment. So once again, we need to decide, right, which method we're using, right? In this case, you see the keyword accounts receivable. So that should trigger to tell you that we're doing the balance sheet method. So that means right here, the estimated amount is at $2,556, right? But that means we need to either add or subtract the account balance in the allowance for doubtful accounts, because my end goal is to be at $2,556 credit in the allowance for doubtful accounts. And right now, I currently have a debit balance of $476.25. So therefore, I need to add, because I'm on the debit side, I'm on the left side, but I need to be on the right side. So therefore, I need to add these two values up together. So whatever $476 is, okay, 476.25 plus 2,556. It's going to give you a total of $30 and $3,032.25. And because it's the end of the year and it's an estimated amount, This should trigger you to tell you that you're doing an adjustment entry, so you're writing off your bad debt. And you're taking it out properly from the allowance for doubtful accounts, right? Because we, as the accountant, we have to use the allowance method, right? Where we can't just write it off directly off of our accounts receivable, okay? And there you go, all right? So that was questions 5 through 10. What happens when you deal with your customers on an accounts receivable? Okay. So let's go ahead and practice the bad debt expense. Okay, calculations here. So if on December 31st, your company estimates that $2,430 out of a $500,000 total credit sales are to be, uncollectible, okay? And there's currently a debit balance of $1,500, okay? In the allowance for doubtful accounts, okay? Record the adjustment entry should be, so in this case, right, our estimated amount is $2,430, okay? What is the key word that we need to look for to determine which method we're using? Okay, so in this case, we see the keyword total credit sales. Now, for total credit sales, what do we do with that piece of information? We need to utilize the allowance method, right? But which one? We need to utilize the income statement method because total credit sales only appears on the income statement, okay? So therefore, do we care about the account balance in the allowance or doubtful accounts? No, we only care about the total estimate. So in this case, the total estimate here is going to be that $2,430. So if on December 31st, you're going to be, right, this is an adjustment entry, so bad debt expense. And it's going to be to the allowance for doubtful accounts. And it's going to be for $2,430 because we're using the income statement method. Okay? So, question number 12, if your company estimates that $2,430 of a $500,000 accounts receivable is to be uncollectible, okay? And there is a debit balance of $1,500 in the allowance of doubtful accounts, okay? The journal, the adjustment entry is, so in this case, right, what are we looking for? Keyword, accounts receivable. So what should that tell you to use? We're going to use the balance sheet method. So in this case, we need to look at the total account balance in the allowance of doubtful accounts because this affects your adjustment. So in this case, we currently have a debit balance. Debit tells you to add. So you're going to add $1,500 to the $2,430 to get you your answer here. So in this case, December 31st, right? It's going to be the same journal entry here, right? You got the bad debt expense and the allowance for doubtful accounts, but the only difference here is you're going to do $2,430 plus $1,500 because it currently has a debit balance. So you're on the left side. You need to be on the right side, which will give you a total of $3,930 even. Okay? Another example here. So question 13. If on December 31st, okay, your company estimates that $2,430 out of 500,000 accounts receivable is to be uncollectible, and there's currently a credit balance of $1,500 in the allowance for doubtful accounts. The adjustment entry is, So this time, it's the same exact situation, but the only difference is you currently have a credit balance in your allowance for doubtful accounts, okay? Now in this case, we need to still determine what is my, what method I'm using, right? So in this case, I am using, right? We have the keyword here, accounts receivable. I'm using the balance sheet method. So that means a debit or a credit balance is going to affect my overall total amount that I'm going to be journalizing. So in this case, credit balance means you're already on the right side. How many more do you need to get to get to 2,430? So remember, how we look at debits and credits is like a number line, right? If you already are $15,000 in, how do you get to 2,430? You subtract the two numbers, and you need to move 930 more credits to the right to get to a grand total of 2,430. Okay, because you already are there with 1,500. Okay. Last but not least, right? Last but not least, we have question 14. If on December 31st, your company estimates that $2,430 of a $500,000 total credit sales is to be uncollectible, and there's currently a credit balance of $1,500 in the allowance for doubtful accounts, the adjustment entry should be, so once again, we need to determine which method are we using, balance sheet method or income statement. In this case, we see the keyword total credit sales. That means we don't even see the allowance or doubtful accounts appear on the income statement. So therefore, we choose to ignore whatever balance there is in the allowance or doubtful accounts, and we choose to only look at one number, and that is the estimate number. So in this case, since it's total credit sales, your total that you're going to journalize is 2,430. Okay? And that is it for the practice of journalizing your writing off the bad debt at the end of the year. Okay? So here we are. Next section, which is 10.2. Okay? 10.2, we took a look at interest. Now in this case, this is what I'm going to assume for both of you guys, is that we are not going to be doing compound interest because, right, we have to assume that not everybody can acquire a fancy calculator, or the, the graphing calculator. And we can't assume that everybody uses Excel for this class, okay? So in this case, that means I'm just going to make it sweet and simple and have something that you can calculate manually on your phone at home on a calculator, right? On a regular calculator, right? So we're going to be dealing with simple interest, okay? So in this case, this is what I'm going to have, a table just like this. So let's go ahead and practice the simple interest and the future value. So what's the formula for simple interest, right? Because in this case, we need to make sure that we plug in our numbers correctly. So to solve for simple interest, right, it's pretty, right? Principal times rate times time equals interest, okay? So in this case, right, the very first one I have here is going to be my principal of 28,000. My rate is going to be 4.35, which we convert that into decimals. So in this case, 0.0435, okay? Times 150 days. Now we need to convert that in terms of years. So what is 150 days? If we already know 30 days is 1 month, 150 days divided by 30 days should give you 5 months. So 5 months out of 12 is going to be what you're going to be calculating here. Okay? And I'm going to equal round this because I know this is going to be 5 out of 12 months is not a very nice number. So in this case, you're going to do principal times the rate of 0.0435 times 5 months out of 12, comma 2. And that's going to give me $507.50. Okay? How do I determine the future value? Right? My future value is going to be my principal. Okay, right? Principal plus interest rate equals future value. So in this case, if after 150 days, this should be a total of $28,507.50. Okay. So next one we have here is a principal of $5,147.50. We got a 6% rate here for 10 years. So this one's straightforward and simple, right? Right? It's going to be principal times rate of 6% times 10 years because it's already in terms of years. Right? So that's going to give me $3,088.50. So therefore, my future value is going to be $8,236. Okay. Next one and last one here is going to be principal times rate of 0.0349, okay, times 8 months out of 12, okay, or that's the same thing as 2 out of 3, right, 2/3, okay. But you could just leave it as 8 out of 12. It's the same thing, right? It's not going to penalize you or calculate any different if you put 8 out of 12 or 2 out of 3. Okay? So that means that's 0.666666666 of a year, right? So therefore, equal round that. I want it to 2 decimal places would give you $15,917.89. If you add those values up together, you should get a total of $700,067.89. Right? And that is simple interest for you. Okay? Last but not least, we're going to be dealing with a bank reconciliation. So this is going to be more or less very similar to the exam because for the exam, on Orbund, I won't be able to actually copy an actual spreadsheet of the actual bank statement with the cash register, ledger, and everything. But on the hard copy of the exam, I'm just going to build it the same exact way so then, no confusion there, okay? So in this case, it's going to be reflective of what you'll see on the exam, where I'm going to give you 3 tables. Table 1 is going to be your bank statement table, right? Table 2 is going to be your check register, okay? And table 3 is going to be your actual bank reconciliation table, okay? So let's go ahead and start on the bank side, okay? So what is my current ending balance in my bank side? Okay, so we got to go to my bank statement. What does my ending balance tell me? Tells me it is currently at $850. Okay? What do I need to add to my bank side? So if you remember your bank, you always do, right? So you're going to have deposits, in transits, and outstanding checks. So first you're going to add any deposits that are currently in transit, okay? So you're going to compare your check register or check ledger, check register, whichever one it is. I have made a total of I made a total of 4 deposits, right? From 44, 45, 46, and 47. And my bank only cleared out deposit number 44 and deposit number 45. So therefore, I am missing 2 deposits, number 46 and 47. So therefore, I need to add these 2 deposits to my bank account because since I already deposited that money into the bank, they're currently being transferred and currently being transferred and making its way to my bank account. So that means it's money I already put into the bank. I'm pending for it to clear. Okay? Because it takes anywhere from 24 to 72 hours to process, depending on what it is. If it's a check, it's going to take time to process. Okay? If it's cash, it should be instant the next day. Okay? And let's see, what am I going to subtract out from my bank? Is going to be any outstanding checks that you have written that have not cleared yet. So in this case, I wrote check number 101, 102, 103, 104, and check number 105. So in this case, let's see. The only checks that cleared from my bank was check 101, 102, 103. So therefore, I have 2 missing checks. Check number 104 and check number 105. Okay? So this is going to be things that are going to be subtracted out from my bank account, right? I'm going to subtract out check number 104 for $50. And I'm going to subtract out check number 105 at $125. Okay? So therefore, what should be my adjusted balance? If I started out in my bank account with $850, I'm pending on a $300 and a $450 deposit. So that's $750 I'm depositing in there. Okay? And I am also pending a $50 check to clear and a $125 check to clear. So in this case, what is my grand total account balance after adjusting these deposits and checks that I've written out? So in this case, right, 850 plus 750 will give you 1,600 minus 175 will give you, oh, I put in the wrong formula. It should be equal sum, my bad. Equal sum should give you 1425, right? So therefore, that's just what I have calculated, right? That doesn't mean that this is true, right? We still have to do the cash side and make sure that they both match on both sides. So in this case, let's take a look at my check register, right? It says right here, my checking balance, ending balance as of May 31st is going to be $1,410. So $1,410. Okay? Things that I will take away from my cash is going to be, we're going to add, is going to be any interest or anything that I've collected that's an auto clearinghouse, right? So let's take a look up here. I have interest collected, right, for $25, and I have an auto clearinghouse, which is $175. So again, auto clearinghouse, okay, is when you collect payments from your customers via whether it's credit card and it's wiring it to your bank account. We call that auto clearinghouse. Other than that too is if you accept online payments, then again, that money is being wired electronically through the auto clearinghouse. And the interest is going to be if you have payment plans and you charge your customers interest on top of that, that is going to be where that interest comes from. Okay. So in this case, you collected $25 worth of interest and $175 worth of auto clearinghouse. Okay. So that means you're going to add this because this is income to you, right? This is income to you. Okay? Because I would have to manually type it in here. So interest and auto clearinghouse, okay, is for $25 and $175. So in this $200 worth of income, extra income. Okay. And then other things that you're going to subtract are going to be any service charges, any late fees, any NSF fees. So if you deposited a check and it bounced, you're going to get a bounce check fee. Okay, so let's see what happened up here. You got NSF fee, $50, and you had a return check fee for $35, and you had bank service charges. So again, if you're using your bank for collecting money, you 100% will be incurring bank service charges, especially if you collect money from a bank account, or you have, like, for instance, a credit lender who's collecting the money from you. 100% they're going to be taking money out from you from your bank for that service charge, right? So again, MasterCard, Visa, right? We took a look at this in QuickBooks. So that's going to be something that you are going to be incurring. So $100, $50, and then $35. Okay. So let's see. We got service charges. We got NSF fees. And we got a return check fee. Okay. So that service charge was for $100. That NSF was for $50. And that return check was for $35. Okay. So again, we need to calculate our grand totals here to see if our numbers match. So we're going to start off with $14.10. Okay. We're also going to add $200, right? $25 from the interest, and then $175 from the auto clearinghouse. Okay. Then we're going to subtract $100 for the service charges. We're going to subtract $50 for the NSF fee, and we're going to subtract $35 to get you a grand total of $14.25. And both sides match. So therefore, we did our accounting correctly, or in this case, we did our adjustment correctly. We balanced both of our books and our bank statement. So that means the next time we do this, this is the number you're going to be starting out with for the next accounting period. So in this case, whatever the date is. So it's going to be for June. All right? And this concludes, and that's, again, this is exactly what I want to expect to see you on the exam, is very, very simple numbers, okay? It's going to be just the do's and just the ifs, right? All right? Other than that, that is it for Chapter 9 and Chapter 10 review.